Hey everyone, Brendan with Wealth Canada here. So I started having a thought, should I be investing a little bit more focused into artificial intelligence? I'll kind of share why I'm thinking that. So back in 90s, 2000s, there was a lot of talk about the internet and websites and email and all this stuff and personal computers. And, there's people that would say how it was going to revolutionize the world. And if you look at where we are now with online shopping, online banking, email. Back in the day, you'd have to have a fax machine and all those things. You have to go to the bank branch to do transactions and stuff like that. And there was a lot of people who thought, yeah, this internet thing, sure, maybe if you're a business executive, you'd have a computer at home, or maybe if you were, a bit of a geek and really into, the internet and you want to have a personal website and stuff, maybe you would do that. And, of course, although nowadays most people don't have personal websites, but they do have Facebook pages or LinkedIn profiles, which really serves as essentially a personal website. It's just kind of in a more, packaged way, so it's a bit easier to get set up. But if you would have invested in Microsoft or Apple back in the day, your returns would have far exceeded the S&P 500, for example. But on the flip side of that, if you would have invested in BlackBerry, you would have done, very poorly. And so that's why I'm a big advocate of dollar cost averaging into the entire market, and whether that's the entire US market, the entire Canada market, most of the international market. I really try to invest in, basically the top companies in the world because some like Apple will really take off and do very well, but then some like BlackBerry might at the time seem like great investments, but then those ones will drop. And so by buying everything, you're kind of hedging your bets and saying, I'm okay with getting the average. Yes, if I invest all of my money into Apple, I would have made way more than the average, which would essentially be the total market. But on the flip side, if I invested everything into BlackBerry and made a bet on that, I would have lost everything. And so what I'm saying is I'm okay with taking the average. And I think that for most people, that really should be the approach, is to say, I'm not going to bet on certain companies because they might do really well, they might do really bad. I'm going to just be comfortable with getting still a very healthy return. And so I'm going to quickly switch gears. I'm just going to pull up VFV. And VFE is a Canadian exchange traded fund, and it tracks the S&P 500 index. Okay, so we've got VFE, TSE, and so let's just look at the last 5 years. So I like using Google Finance. I find it does a really good job of just quickly pulling up charts here. So looking at the 5-year chart, we can see that the S&P 500 has gone up 104% in 5 years. So if we divide that by 104 in 5 years, so we divide that by 5, more or less about 20%, a little bit or more than 20% per year, which is quite phenomenal and quite exceptional. Normally it's more, between that 9 to 11% range. So one other cool thing that we can do is when you click onto that, I'm just going to go back and show you what I did there. So we Googled VFE stock market. I'm going to scroll down and click on more about this and click on that. You can also, of course, just go directly to google.com/finance and then pull it up that way as well to get to this page. But what I want to point out to you is this compare to little button here. I find this very useful. So if we wanted to look up Apple, for example, we just type in the word Apple, and we can see that there's a few different ones that come up. So we'll click on Apple, and we're going to go with NASDAQ. We want the US one. And then we're going to look at it on a 1-year basis. And so here we can see on a 1-year timeline, the blue is the Vanguard, S&P 500. So the 500 largest US companies, and then we have Apple here in yellow. So we can see that in the last year, the S&P 500 has done, 34%, and then Apple's done 30. And then if we go back 5 years, now this is where it really stands out. We can see that Apple's done, almost 3 times more. Now, it is important to keep in mind that this is 5 years from a single point in time. And so be aware of that. You're looking at a certain day 5 years ago to what it is today. So these numbers shouldn't be relied on as like super accurate numbers. They're used for just getting a quick ballpark or just a real quick snapshot of it. Because as you can see, if you would have looked at this point in time on April 19th, 2022 to this point in time, then the S&P 500 would have performed better. Because Apple was up and then Apple went down, the S&P was higher. So, that snapshot wouldn't look good. So even by doing 5 years, we're looking at it on, November 8th to this day. So just keep that in mind. These numbers are not absolute, perfect numbers, but for the most part, they help. You're not getting an actual annualized average is what I'm trying to say. So we can see here, if we would have picked Apple 5 years ago, we would have done, significantly better. And however, though, and I'm not really able to go back too much further. If we go to Max, this is a very distorted view because you can see that Apple's going back since 1984, whereas VFE's only started in 2012. So Max is rarely a reliable way to look at charts, to be honest with you. But if we were to pull up, let's do BlackBerry. And we'll do this one. And then I'm going to take the VFE chart off. Oh, actually, what I need to do is I need to first... So it's not going to let me delete VFE because I started with that chart. So I need to just kind of do a new search here for Apple. Start with Apple as my base. Then I'm going to add in BlackBerry. Yep. And then also keep in mind that I'm comparing, a Canadian dollar Toronto Stock Exchange to a US dollar or NASDAQ. So, that's why those numbers aren't absolute, because I'm comparing, things, different tickers in different currencies. But let's see, Max. I'm just curious how far this goes back. So this still isn't really a great one. Let's go 5 years, though. So we can see that 5 years ago, even if we would have been invested in BlackBerry, we'd be down 50%. Apple would have been up 300%. And then if we add VFE back in, we're at 100. So that's why my entire investing approach comes back to I'm okay with the average. I'm okay with getting the middle because I'm too risk adverse to try to pick specific stocks, and then you might end up losing a lot. Now, of course, there are some people who really spend a lot of time and dig into the data on different symbols, and they do their research, and they might stock pick. And I think that obviously is totally fine. But for the average person who isn't necessarily super interested in this stuff and just wants to have a safe bet kind of across the board for the most part, this would be that safe bet as opposed to, picking specific stocks. So that's what that's all about. Now, back to the initial topic about artificial intelligence. So let's go back to these stocks that I pulled up. So we have here a handful of different artificial intelligence stocks. Now, you may or may not be comfortable investing into specific stocks and stock picking. And so that's where an exchange traded fund comes useful. Now, one other thing, just another little side thing that I thought of here, is I noticed that this frequent search here is artificial intelligence stocks under $10. So I'm going to use this as an opportunity to quickly, explain one thing, and we'll go back actually to where we were here. So on this comparison, then let's look up VFE again. Just a quick note. Sometimes people ask me, does the price matter? Some people say, the S&P 500 on Vanguard is cheaper than Apple, so that must be another reason why it's better. The truth is the price doesn't matter at all. If you think about it, think of it like buying, for example, like packs of eggs, just as a simple thing comes to mind. You could buy a dozen eggs, and let's just, to use simple math here, because I don't want to do, let's just keep it simple. So a dozen eggs, let's just say it's $12. $1 an egg. Now, a 6-pack of eggs might be, for example, $6. And so you might say to me, oh, well, that pack of eggs is $6 and this pack of eggs is $12. So wouldn't the six pack be better? And if we look up, where this really becomes important is if we look up, oops, gotta fix my keyboard here, S&P 500. Let's see, like for example, BMO. I didn't really do what I wanted. BMO. Okay, there we go. ZSP. So ZSP is an S&P 500 index ETF managed by BMO Bank. There's also, a TD one, and I don't know the name. Oops, I'm gonna just search for it here and see if that comes up. It doesn't, that's okay. We'll stick with just BMO and our Vanguard one for now. So as we can see over the last 5 years, their returns are nearly identical. In this case, a 1% variance over 5 years, is quite insignificant. But I mean, it is nice to see that Vanguard came up on top. Let's look at a 1-year view. Yeah, it's very insignificant. Now, the prices are completely different. So sometimes people ask me, and actually quite often people ask me, a lot more often than I would have ever thought that it would come up. But people say, hey, does the price matter? I'm going to buy the BMO one because it's cheaper than the Vanguard one. Hey, Brendan, why do you like the Vanguard one? It's more expensive than the BMO one. You're getting a better deal here. It doesn't work that way. So it's just per share or per unit of the exchange traded fund. That's the price. But as you can see, they both move up at the exact same percentage. So if you put in, let's say you bought 2 shares, that'd be, 280, and then 3 shares of the BMO would be 260. So kind of close there. 3 shares of this and 2 shares of this. For the most part, it's like if I said, hey, I'm going to put in $500 into this or $500 into this one, they're going to move up the same percent. So the difference of the unit price doesn't really matter. Think back to that pack of eggs, whether you buy a pack of eggs for $6 and a pack of eggs for $12, it's within that, that's different. So it's like if you bought 2 6-packs for the same price as one 12-pack, it's like, well, I got 2 of those, but it doesn't work that way. The number of units here, it's like 2 units of this isn't worth more than 1 unit of this. It's, $500 in that, $500 in that. At the end of the day, it's the same thing, and they're going to move up to the same percent. So just a quick thing, and kind of to get back on track here, but I just thought of that when I saw that under $10, and I just wanted to mention that because it's rarely a factor. Let's search exchange traded fund. Let's search Canada. So if we don't search Canada, we're going to get exchange traded funds in the US and Canada, which, may be okay. I personally prefer to just buy things in Canadian dollars anytime I can avoid it because I don't like that constant currency exchange. Obviously, when you buy a Canadian exchange traded fund and they're investing in US stocks, there obviously is a currency exchange that is happening, at some point in the process, but the fund manager is dealing with that. So, people ask about Canadian or US. Truth, it doesn't really matter too much, but for simplicity purposes, I like to just keep it simple and buy Canada. Okay, so these are Canadian exchange traded funds. So just by looking at this, the 2 that jump to my mind are Global X and Evolve. Those are 2 very reputable ETF fund managers that I recognize. So we're just going to click into those. So we'll go into that one, and then we'll go into this one. And then also Motley Fool. This is one that I'm... this is a pretty good article or a pretty good website for investing articles and stuff. So I don't read it on a regular basis. I actually want to start to see if it would be useful to do that a bit more often. All right, so we go into these pages, and I want to walk you through what we're seeing here, because for a lot of people, seeing this information for the first time, can be quite confusing. So let's start with Evolve. All right, so up here we got TSX and then ARTI. So think back to our VFV example and how I talked about TSC and VFE here. So exchange and then the symbol. And note that here they refer to it as TSE, whereas here they refer to it as TSX. So same thing, but they're referring to it's just a different acronym, which I find incredibly annoying that it's not standardized, but that's for another day. All right, and then we got the symbol here. So when we scroll through it, we can see here, so there's the ticker symbol, number of holdings. To be honest with you, for the most part, you don't need to worry about the other numbers here too much. When you're looking at very reputable, what's the word I'm looking for? Very diverse, kind of high-level exchange traded funds. You don't need to worry too much about the details. However, if you do want to research and look into them, highly encouraged to. So just a quick recap on this. NAV, this is saying the net asset value. So one share of this exchange traded fund is worth $11.01, and the current price it's trading for is $10.97. So when you buy it right now, you're getting it at a bit of a discount. So you're buying it for this much, but you're actually getting that much value. So you're making 4 cents on that. But I don't even worry about things like that because it's at the end of the day, it doesn't even matter for the grand scheme of things. Okay, so in this one, you can see it actually is active. So with S&P 500, that would be a passively managed fund. This one actually is actively managed to some extent. But the really important number that you're looking for here is we want to see number of holdings. We want to look at what's actually owned within it. And then the other thing we want to see is the fees. We want to check and see how much of a percentage fee are they taking. And it's actually disappointing that that is not front and center. So let's just see here if we can dig into that a little bit. So I would have also thought it would be here. Oh, here we go. Okay, it's a little bit buried. So 0.6, not the worst I've ever seen, but I would say that is on the higher side. If we look at, for example, VFE, and if we scroll down and we click on the Vanguard website, we'll be able, this is loading weird, we'll be able to see this is what Vanguard is, front and center. The big number here, they got the price or the fee. So 0.09%. So we can see that the Evolve artificial intelligence one is 6 times higher. But you have to remember, these are investing in completely different things. So you can't just compare fee to fee, right? It's like looking at the sugar content in peanuts versus apples. Like it's completely different things. It's not even a way to measure it. But it is something just to be aware of. So that is on the higher side. And then we can also see here that they do distributions on an annual basis. For the most part, these artificial intelligence and technology companies in general, for the most part, don't really have dividends. And if they do have dividends, they're quite small. But that's kind of another thing, is that so many YouTube videos and TikToks I see are raving about dividends. And what people don't realize is that dividends, when you're young and you're trying to grow your money, you shouldn't really be that interested or excited about dividends, because you should be more interested in capital growth of your actual money, equity growth, versus receiving dividends off of it. Later, when you're going to be retiring, then you might move some or all of your portfolio to then follow a dividend strategy. But initially, your focus should just be to grow that money for the most part. Whereas, and the S&P 500 has quite low dividends. It's like a 1%, which is fine. So people might ask, hey, why am I investing in a 1% dividend? But it's not about the dividend. You're looking at the total return that you're getting. All right, so we got our fee. It's a little bit on the higher side, but that's okay. And then now let's click into the holdings here, and we can see what we're actually invested in. So we can see here, for the most part, in the US, a little bit Ireland, a little bit of Uruguay, and a tiny bit Canada. And then we can see exactly what they're owning. So you could go and buy all of these stocks yourself and avoid the 0.6 MER fee. But the benefit of this is that they're automatically adjusting these percentages as needed, so you don't have to worry about them. The other thing, let's quickly look at the Global X1, and then what I'm going to do is compare them. All right, so yield 0.1, I don't even look or care about that because I'm not investing in this for dividend income. I'm investing in it for growth. Again, when we look at the price, we don't need to concern ourselves with, hey, this one's 30 and the other one was whatever price it was. If we're putting 500 bucks in, 500 bucks is 500 bucks. Doesn't matter how many units we get at certain prices. Now, just a little note here is that you are paying this much, and then that's the actual net asset value. So you are paying slightly more than it's actually worth. But again, in the grand scheme of things, it's irrelevant. This changes. So it's just the day you happen to buy it on. But if you're dollar cost averaging, that doesn't matter. Risk rating high. The reason it's high is because you're investing into one specific sector, or in this case, maybe two, because it's robotics and AI. And then I want to go into holdings. So actually the fee really quick. This one also buries it a bit. Okay, 0.45. So definitely a little bit lower. Now, keep in mind though, there actually is a management fee and a management expense ratio. So this one's actually 0.64, and I believe this was 0.65. So in that case, they are actually pretty much identical, which makes sense because they're fiercely competing. There we go. Okay, 0.6. So this one is slightly lower. What's the difference between a management fee and an expense ratio? So the management fee is what fee does Global X take to manage and administer the ETF? And then the expense ratio takes into consideration what is their fee plus what are their expenses, like transaction fees that they get charged and currency conversion fees that they get charged. So the management expense ratio, the MER, is really at the end of the day the only number that you care about. But this is just saying, hey, that's how much is actually going to Global X directly. But ultimately, we don't really care about that. We just want to know what's the total fee that we're going to pay at the end of the day. And then also just to really quickly on holdings. So this one's interesting, actually. So surprisingly, I would have thought that these would have been very similar. And it could be that this is robotics and AI. This is AI. So they are slightly different funds. But this one is only 48% US and then quite a bit in Japan, Switzerland, Finland. So that is a little bit interesting to me. And then if we look here, NVIDIA is top holding and then others, but see, we don't see Meta, we don't see Apple. So that is interesting. So the holdings in both of these are actually quite different, even though they're marketed, kind of in the same circles. So what I find really interesting about these different exchange traded funds that track artificial intelligence is that if we look at a 1-year view, we can see here that we've got this artificial intelligence and technology ETF, we've got this robotics one, and then we have the Vanguard SP 500 looking at a 1-year timeline, and they both track very, very similar. The artificial intelligence and technology slightly outperforms the SP 500, but it's so insignificant. And then the robotics lags a little bit. But that's why I like the SP 500 so much as an investment option for majority, kind of the average person, is just because with both of these funds, you're taking on more risk because you're investing your money into one specific sector or industry. Whereas with the SP 500, you're invested in every single industry, every single sector that's out there, kind of in the States. So here you're getting very broad market diversification, and you're seeing an excellent return compared to these two that carry more risk, and the returns are very, very similar, if not sometimes even lower. And then if we go to the 5-year, we also have that too. Now, this is where there's the argument that, hey, if I invest into a specific sector, I'm able to do well. Now, when we look at this artificial intelligence and technology, you would have made 135% over the last 5 years, whereas the S&P only did 104. So you are seeing less of a return. But then look at with robotics. If you would have thought that robotics and AI was like the hot thing to invest in, and you picked that ETF, you'd be at 45. So I'm okay with getting the middle. I'm okay with missing out on some of the big winners, but then I'm avoiding some of the ones that don't perform as well. And then if we were to pick specific stocks, let's just pull in Apple for fun. So Apple would have incredibly outperformed all of these, 300%. And then on the flip side, I know BlackBerry has been on the on the decline for some time. So hopefully no one was investing in that 5 years ago. But BlackBerry would have done, significantly worse. So just kind of to show you how those compare. And then just for fun, let's just throw in a couple other ones. So let's look at Walmart, for example, and see where that lines up. So 105%. So basically identical to the S&P 500. And let's also just look at Costco, another fun one. Check out 195, so would have done quite well too. So as you can see, you can pick which one you'd invest in. I'm taking the orange one, which is the middle. So it's not the best, but look at how we saw BlackBerry went down so much, and then in this case, we see Apple go up. But it's like, I mean, Apple's safe to say probably going to do well for a really long time, but at the same time, a specific company can start to do poorly at any given time. Whereas the orange here basically just amalgamates everything and kind of is an average of it all. So hopefully that's helpful. After kind of doing this research, I'm not going to be specifically going in on AI. I'm going to take out Apple because I'm not a fan of stock picking, so I wouldn't really do the direct ones anyways. There might be a case, so we'll take out robotics. And another important thing to mention is that historical returns do not guarantee future. That always has to be said, but at the same time, historical is really the only thing that we have to go on to look at, what might the future hold. Well, looking at historically is probably a useful metric in order to be able to see, how might it do in the future. And so, I don't look at this and say, okay, well, if I'm going to invest in this and get a guaranteed 135 in the next 5 years, that's the wrong way to look at it. But you can look and see, okay, what did it do? So I'm going to eliminate that one. When it comes to specific stocks and ETFs, you can't purely look at the return, but when it's very diversified within that industry, that's when you can start to kind of look at the return. And especially it's, made up of, dozens of companies, and it's by a reputable fund manager. So that's where you can start to look at the percent a little bit more. If it was specific companies, I for sure wouldn't do that way. So I may start to, dollar cost average, maybe, for example, 5% or 10% of my portfolio. Honestly, probably 5% is kind of where I'll do it for now, and just kind of start to trickle that into the artificial intelligence a little bit. Because I think that going forward, that's going to be big, but I mean, it's not financial advice, and kind of don't take my word for it. So who knows? But that's why I'm going to do a smaller share. So hopefully this video was helpful. Please subscribe, please hit the like button, and we'll see you in the next video.